your mic. Ah,
No, if that if that garage that if you are going to go those side, but you know that you pass to Central Mosque.
Opeyemi, mute your mic.
What's going on like this? You're not gonna do this.
I'm not
Stop now.
I feel studying for my own.
Where's your mom?
Yeah, trouble to start with that. No, that's it. So that
Come on, man.
you come and see it.
Look, how's business? Longest time. Just give me a roll small. I want to go with that bowl. That's a just
You guys
Come on.
should find
She be Khadija dey. When Khadija dey again.
Like a problem for someone. Like, can we just mute our mic for once, please? Eh?
Just come, you know.
You people should mute your mics now. Please, mute your mics. Mute your mics. Are you people not tired? Mute your mics. We keep on saying the same thing every time, every day. It's not fair now.
Yes, sir.
Can you imagine? Now I'm still talking Oyana. Just mute your mic.
Hello,
Eh?
I think
Yes.
Madam Khadija, I thought there was a way you used to mute everybody. Why don't you repeat the same thing here?
I was made a host or maybe probably a co-host. But now I'm not any too. I don't have access to doing that.
If you are made
Please, from my view here, I see that Lady P is a host. Why don't you chat her so she can make you a co-host and then you meet everybody?
Exactly. Exactly.
that
Daniel, please, what's the update? What's the issue now? Daniel, please, can you hear me? Daniel.
I thought he wants to reach out to the lecturer.
I don't reach out to them. The lecturer is not replying me. I don't know what's going on.
So that's the update now.
Oh my. I don't tire. Oh. I'm tired though.
Yes, I can hear you. Yes, I can hear you.
Can you reach out to the lecturer too from your hand? Let's know if he's going to reply you.
So I was talking on characteristics of partnership. I was talking on characteristics of partnership before I was logged out. We have looked at the characteristics of a sole proprietorship, duration of partnership. Legally, a partner in a partnership venture comes to an end at the death, retirement, or bankruptcy of any one of partner. But if the remaining partners agree to work together under the original firm's name, the firm will not be dissolved. So in essence, for as long as there's no unanimous agreement between partners that the business should be shut down, the business has the right and the mandate to continue to be in existence. I hope we can hear me clearly. I believe you can hear me clearly. Legal basis. A partner venture is not a separate legal entity. That is, the name, if the name of the business is Jolly Jolly and Co. Jolly Jolly and Co. will not be seen as different from Jolly A, Jolly B, who are the different owners who come together.
Excuse me, sir. Excuse me, sir. The last time that you were taking, can you hear me, sir?
Okay.
Okay. The last time you were taking us earlier, you stopped at sole proprietorship, not partnership, sir.
I was running the slide. I never knew you were any part of it. So I've moved from partnership. I'm now on. I've moved from sole proprietorship now on partnership. What are the things I mentioned under sole proprietorship? We say in sole proprietorship, there are advantages and there are disadvantages, and there are what we also call characteristics. So I mentioned all the characteristics, that it is usually owned by one person. Mention the characteristics that this type of business is a business that can die when the owner is no longer existing. It's a type of business that is very flexible, and so on and so forth. And we mentioned the advantages, that the owner of such business can easily take decision without having the business enjoy all the profit all alone. The owner of the business can decide without any prejudice. So say it also has disadvantages, and this is so they cannot easily get as much money as they wish. They cannot expand as they wish. So we mentioned all this. We also say that this kind of business can die immediately once the owner dies because it's owned by just one person. We say this type of business does not enjoy flexibility of like having a robust decision because it's two good head they say is better than one. Because it's a one head, their decision may be very fast, but may not be the best quality decision. So those are the recap of what I capture under that. Because when I was taking it, I never knew that I've been logged out. And that's why it's not good for you people to be calling into my line because I use the data from the line. So I hope I've been able to recap what we did under sole proprietorship. Everything is in this slide. Is it okay by you? Hello?
Yes, sir. You can
Hello,
just continue with the class. Yes, sir. Yes, sir.
Okay, so okay. Voluntary registration. Firm registration is not compulsory, but an unregistered firm has some disadvantages, just like I said earlier on. You may see some company, they will put their flag there or their signboard and say Julius and Co, this and Co. If they are not registered, they are just existing without recognition by government. So if government has things to give out, those kind of people will not benefit from what government has to give out. Government has to say, okay, those people in this category of business, this who don't make this up to this level of profit, we are going to support them with this amount, that amount. Those who are not registered with CAC will not benefit. So when we say it is not compulsory they should register, there are disadvantages that arises when partnership or any business for that matter fails to register with the appropriate government body. And we say the appropriate government body that registers business in Nigeria is called Corporate Affairs Commission. Corporate Affairs Commission. If we are having partnership, there must be deed, there must be agreement between those people who have formed the partnership, which must also be submitted to the Corporate Affairs Commission at the point of registration of that company. So we call it partnership deed. Inside that partnership deed is where the agreement between the parties are contained. How much you are putting down, what role you are going to play. Are you going to be there on daily basis? Are you not going to be there on daily basis? If you are not there on daily basis and you are just contributing money, how much will you be getting for the money you have contributed? How much will the person that is there on daily basis running it will also be getting, apart from the money has contributed? So all those things contained in the document, in that agreement, is what we refer to as what? Deed. Okay? So you will find things like the nature of the business in the deed. You find things like the date of admission of each member inside that deed. You find the name and permanent addresses of the partners, the total capital contributed by each. You will find it in that deed. Responsibility and authorities, duties of respective prepare them and how to do the auditing. You find all in it. So partnership deed is very, very vital. If loan will be accepted from a partner, apart from his capital contribution and will be paid interest upon, all those things has to be in there. In any case, what we are saying is that anything not in the deed will not be allowed. They have to also carry the. If they just discover that they need more money and one of them must bring more money and it's not in the original deed, they will have to go back to CAC and seek for the amendment whereby that clause will also be included in the deed there. So those are all those things that must be included, and then including their salary, profit, and loss sharing. All those must be included in the deed. So at any point in time, you now remember that, oh, this one's supposed to be in the deed, but it's not there. You have to carry the deed, approach the CAC, and all the formalities involved to get it included will be done so that it can be established. It's just like people who are coming together to form a template that will be the basis on which they use to govern themselves. So that's what the deed does between partners in a business. So partnership deed cannot be ignored. Okay? I've talked about when a business is not registered, whether it's sole business or partnership. If a business is not registered, it has what we call disadvantages. Partner cannot sue the firm because it's not registered in the first place. If your right is violated, you have nobody to sue because in the first place, that business is not registered. The firm cannot sue any third party for recovery of claims or entitlement. Why? Because it's not registered. You have types of partners, active or working partner, you have dormant or sleeping partner. And that's what I was saying when we are talking about liability. There are some partners that if the business runs into problem, you cannot hold them responsible. So you have partners based on what? Profit sharing. So when you look at them now, we find out that each of them, when you say active partner, this partner takes active part in the daily management. Dormant partner or sleeping partner, they do not take active part in the daily management. That's different between the two of them. Then you have partners based on profit sharing. This may be classified into two, nominal and what? Partner in profit. Nominal partner, they have no interest in the business, but they allow the firm to make use of their names as partners. They do not make any capital contribution and are not allowed to take part in the management of the firm. However, like other partners, they are liable to third parties for all the firm's activities, and they are not entitled to share the profits of the business. If somebody's name is very popular may tell the children, okay, if you want to go into business, you can use my name since my name is very popular. And so because their name is being used, they will not be exonerated if the business has problems. So they will have to agree. So if you are not having a meaningful connection to such business, you will not allow your name to be used as a nominal partner. After all, you are not going to share part of the profit. Okay? You see some people, some ladies, even after they've married, they still enjoy partnership with their father's name. They will do it as compound name and still include their father's name. Why? Because of the goodwill of that name. Some the name they are bearing before they marry is a very powerful name. So they want to still enjoy partnership of that name. So, but if they are making profit, they will not say, go and give it to the man that owns that surname. They will not. So we have partner in profit. These partners share in the profit of the business without being liable for the losses. Those are the categories I've mentioned earlier on. They've made contribution. They've put in money to sponsor that business. But if that business is run badly and there is loss, the only thing that person will lose is the money he has contributed. You cannot go and take the private car of that person, collect building of that person, and go and sell. Okay? So we have partners based on liability. In this category, partners can be general or limited liability or limited partner. General or limited liability are partners who have unlimited liability. These are the category of partners that if they have houses, they have vehicles, they have land, all those things could be sold if the business runs into debt. The debtor can take over of all those things to make sure that redeemed what is being indebted by the partnership. You have partners based on liability. In this category, partners can be general or unlimited, just like we said. So please understand all this. So there are questions and answers. Say define general partnership type of business, and so all this I will pass to you in the slide. I'm going to leave this slide for you. So after this class, let the respective class governors interact with me to collect the slide I'm using now. So we have general partner. The partnership type of association has the following advantage. It's easy to establish, just like we have said, because in this case, two or more people will bring their money together. But remember that when they are bringing what they have together, it should not be more than 20 people. And it should not be less than 2 people. High caliber of people can be employed, unlike sole proprietorship that is just one person. If you talk about partnership, they can choose to engage more competent people to work for them because they have better resources to engage more qualitative person. A sole proprietor cannot say he's going to hire a chartered accountant or even a first degree holder accounting person. They may not be able to do that. Okay. But in partnership, they can hire more qualified person to handle some things for them. They can bring reasonable amount of money together because the money is coming not just from one person, it's coming from multiple individuals, at least up to 20 in some cases. They can make higher quality decisions because, like we have said, 2 heads is better than 1. They can make better decisions. They enjoy one level of taxation. They don't tax them twice. They don't say this is the money the company has paid. It has paid 2 billion. So we collect tax from that 2 billion. Then after collecting tax, we share the money to the partners. Then after we share to the partners, each partner will also pay tax. No. Once they have collected tax from the profit of that business, that's all. That's why we say one level taxation. Flexibility, that is more flexible type of business ownership. Please, in order to avoid what happened in the initial stage, are we still together? Because the initial stage, I just keep on moving,
Why
thinking
yes,
that
sir.
we
Why
are
yes,
there,
sir.
not knowing that we are
Why in class, sir?
Okay. So merits also include risk sharing. In contrast to sole proprietorship, in general partnership, you may have a number of partners who are involved in risk. You know, there are some of them who will, what they put in is their money. And if the business has problem, what they will lose is their money. But you still have some category among them, that category they belong is the category of those people who will bear the what? The risk. And because they are going to bear the risk in the first place, they will make sure they guard against the risk. They will guard against it. But in sole proprietorship, no matter what, it will bear the entire risk all alone. It has nobody to share the risk with. Defaulted interest, because it's your business, you want to give it everything to survive, especially those people who are involved in the day-to-day running of it. They don't have any other things to live on more than that. So they do all possible to make sure they work for the best interest of the business. You have some people who have come together. Among the 20 people who have come together, you may have somebody who is very good in management of customers. You may have another one that is very good in innovation, designing something good, things of higher quality. You may have somebody that is very good in marketing. You may have somebody that is very good in motivating others. So you have specialization. You have people who have different expertise in different areas that can help the organization. Security of interest. Here, the right of every partner and benefit. They know if a doom occurs to the business, one way or the other, the money has contributed. In any way, it has also suffered loss. So all of them will want to guide against suffering loss together. Confidentiality. They want to make sure they don't release information that can kill the organization, because in any way they will have competitors. So they want to keep things confidential so that their business will not be jeopardized. It has its disadvantages. Instability or uncertainty of existence. In some cases, there could be unresolvable issues which can make them to close up. Mismanagement of fund of the resources can cause bankruptcy. Death of a major partner can also cause the business to be closed in some cases. There are some categories, just like we said earlier on, and some categories of partners who bear unlimited liability when there is liability. Also, because they are limited in number of people that can come together, there's also a limit to what. And that's why we have other types of businesses now. That's why we have private limited liability and we have public limited liability. So 20 people, there's limit to the resources they can raise too. So they can raise a bit more than sole proprietorship, but there's limit to what they can raise. They cannot raise more than what the 20 of them to put together. That is, if I thought they are even up to 20 in the first place. Risk of implied authority. In partnership, some obligation may occur from one's own act and from the act and mistake of co-partners. That is, you may be so careful, but unintentional behavior of your partner can bring the business into trouble. And when the unintentional action of a partner brings the business into trouble, everybody will suffer for it. That's what we are simply saying. That is, it's not intended, but it occurs all the same. The person who even brought the harm to the organization did not plan it. Does not mean in that way, but it happens. Non-transferability of shares. You cannot say, because the father owns the share, if it's no longer available, it's the son that will own it, except it is included in the deed of agreement. Except it is included in their deed of agreement, right from the onset, that, oh, if any of them has a son that, or a daughter that has become capable and has this content or character, the share of the father may be transferred. But generally, it is assumed not to be transferable. But in the event, if they put it in their deed, then Nobody can say what they have in their deed should not fly. Conflict is possible among partners. They may have reason to disagree on certain issues, and if the agreement gets to the level that it is no longer resolvable, it can lead to the business coming to a close. They dissolve the partnership. Unfair distribution of labor. Some may be involved more, some may be working harder, some may be working little, and they will still be sharing. Even the person who is doing little may still be sharing in the profits, almost in the equal way with the person who is working more. There is a concept of social loving, unfair distribution of labor. In social loving, if I give all of you assignments now and I group you and say 20 people, out of 20 people, it may be only 3 people that will work to bring the assignment, but they will put the name of 20 people there. So 17 people may not contribute fairly. They just some may not even contribute at all, but they will be aiming to get equal mark. So that's unfair thing we are talking about. Lack of institutional confidence. Usually, the type of partnership activity is not made known to the public. Okay? So in most cases, because they want to keep a lot of confidence, issues about them are not clear to the outsiders. Difficulty in withdrawal from the firm. Investment can be easily made, but difficult to withdraw because for a partner to withdraw his share, the consent of all partners, that is co-partners, is required. You cannot just go and meet the person that is your friend and say, okay, I'm no longer part of this, your business. So because I've told you that you are my very close friend, so from today, since I've told you I'm no longer part. No, others will have to also agree. And for you to get all of them agreed, it's another thing. Difficulty in expansion because it's not individual's decision. Everybody will have to agree to that too before you can expand. Business perpetuity, that is continuity of it too, is fair compared to sole proprietorship, but it is not also guaranteed that such businesses will exist for life as well. Along the line, somehow, the partnership may eventually dissolve. You have gotten partners who have with private hospitals, partners who have come together to operate a private law firm. But after those people die, their children may not be interested in those line of business, and before you know it, so those businesses may be sold. So the partnership ends there. So limited liability in partnership simply refers to those who come into partnership with the intention that their money is what is speaking for them in that partnership. And so when there is problem in that partnership, what they are losing basically is the money they have brought into that partnership. I've spoken about it earlier on, so I don't want us to burn too much strength on that because we still have about 2 other aspects to cover. So that's for limited partnership, which I've spoken on earlier on. Those are the ones that they are limited to what they have brought into that business. So there's question you will respond to when you see this slide. So make sure you do your best to respond to them. So let's go to private and public limited liability. Those categories we refer to as incorporated entities. The first 2 we discussed, they are those that are not what? Incorporated. They are not incorporated. These ones are incorporated because the owners of this one, they are those ones we normally refer to as shareholders. Shareholders. Now, in private limited liability company, the minimum number of owners is usually 7, and the maximum is usually 50. Now, when you are talking about private and public limited liability, let me quickly give you some of those things that distinguish between the 2. Private limited liability company is different from what? Public limited liability company. Yes, both of them, they have shareholders, both of them, they share profit. Yes, I agree. Both of them, they have to register with the Corporate Affairs Commission. I agreed. Okay? Both of them are managed by competent hands. I agree. Both of them, they pay tax, both as corporate and as individual. I agree. They have all those things in common. Both of them have what we call board of directors. I agree. They have all those ones. They have advantages which include easier to form. They have legal status, that is, you can sue them and they can also sue, unlike sole proprietorship. The concept of limited liability applies, yes. It has flexibility, yes. Taxation, yes. But then, I will talk on it from this perspective. When we talk about private limited liability company, private limited liability company has 7 minimum, maximum 50. But public limited liability company has minimum 7, but maximum no limit. Maximum no limit. Do you get the point I've made? Public limited liability has minimum of 7 shareholders, but you can have as many, no limit. But for private, the maximum is 50. Please take note of that. Now, I will also tell you another major thing that distinguishes between private limited liability company and public limited liability company. Now, a private limited liability company can upgrade, just like sole proprietorship can upgrade and become partnership, just like partnership can upgrade and become private limited liability company. Private limited liability company can upgrade to public limited liability company. Now, I want you to listen to me at this point. Private limited liability company, their shares, I told you that both of them have shareholders. But apart from the number of people involved in ownership, that is minimum of 7, maximum of 50 for private, then minimum of 7 for public, and there is no maximum for public. Now, listen to me on this note. Private limited liability company, you can not get their shares outside. You cannot buy their shares. You cannot wake up one day and say, I want to become part of the shareholders of this company. Let me go and give money to my stockbroker to buy shares of this company for me. You cannot find their shares outside. No, you cannot get their shares outside. But for public limited liability company, you can get their shares outside. That is, you can easily give money to your stockbroker and say, go and buy the shares of this company for me. First Bank, go and buy the share of this company for me. Nigerian Breweries, go and buy the shares of this company for me. He said, because they are listed. The shares of public limited liability companies are listed on the floor of Nigerian Stock Exchange. They are listed on where? On the floor of Nigerian Stock Exchange. And so, you can choose to be part of the owner today, and tomorrow you can choose not to be part of the owner again. You share your shares to another person. That's all. Nobody ties you down. You can easily leave the share, but in case of private limited liability company, you cannot just easily do that. Because out of those 50 people, if one person will leave among the 50 people in the private, the rest will have to be informed. You cannot just live quietly the way you can live in public by just selling yourself, because your share is there. You cannot sell it to the public in private. So you have to discuss with them. Maybe one of them will be willing to buy your shares and pay you off, or they will agree that, okay, maybe you bring somebody for them to examine, and if they feel that person is befitting to be part of them, then they will unanimously agree that that person can be part of them before they admit. So you can see things that distinguishes between public limited liability company and private limited liability company. I emphasize on this because if at any point in time you are required to distinguish between the two, these are the basis on which you can distinguish between them. So, in essence, in these types of business, public limited liability company, if the business has problem, the business goes into debt, you as a shareholder, you cannot lose your personal belonging to that business. And that's why you see all these banks that are public limited liability banks. When they have problems, you see some debtors, they will quickly be rushing to that place. If it is vehicle, they can see in the compound. If it's anything outside, they believe they can easily grab. Why? Because if the business of any public limited liability company has problem, the owners will not be held responsible for the loss. So that is, if there is a debt, you cannot go and meet a shareholder of a public limited liability company, bring your share. I mean, your personal car, I want to sell it to you. You cannot. You cannot. If he has a landed property, you cannot say you want to go and take over his landed property. No. If he has houses, you cannot say you want to go and sell houses. The best that can happen is the money the person has brought into that business, and they have used that money to set up that business, the building for the business. That's part of the money of the shareholder. They used to buy the building for the business. They used to buy vehicles the business is using, and all those things. So all those things that business has, the building they are using for business, the vehicles they are using for business, and all those things. By the time you have sold all those things and nothing more, you cannot go back to the individual owners and say, bring the owner, the personal things you have. No, you cannot go to the court and win them, because the law, the CAC law that establishes them, absolves them from what? From such liability. And that's why they call it public limited liability company. That's why if you have 1 billion in a bank that is public limited liability category of bank, and the bank now folds up, the authority that will decide what you are going to get is the authority of the CBN. They may set up a body, and they will now say, okay, all they have recovered from this company, from the sales of their buildings, vehicles, or whatever cash they have in the any savings anywhere, is 2 billion. So if they own a particular person 1 billion, it will not say they should come and give him 1 billion from the 2 billion. No, they will determine how many people they have to pay. And they may now say at the end of the day that, okay, each person the organization is owing will be giving 50,000. So the remaining loss, you bear it by yourself as a person they are owing. You cannot go and meet any of the shareholders. And that's why if you are keeping money in bank or you are doing anything with public limited liability company, you have to open your eyes very well. You have to do what? So you can see that they are quite interesting because they are all interwoven. Just like I've said from onset, so proprietorship can graduate, can grow and become partnership. Partnership can grow and become what? Private limited liability company. Private limited liability company can grow and become public limited liability company. They all have their advantages and disadvantages. And those ones are very easy for anybody to pick. Of course, when an organization is big, they can get more money to do big things too, isn't it? Aha. Now, let me talk about I've mentioned this one earlier on, right from the time I was talking about sole proprietorship, the issue of taxation. In partnership, in sole proprietorship, you don't pay tax twice. What do I mean by this? If your profit is 1 million in sole proprietorship, the tax will be taken from that 1 million, then you enjoy the rest of your money as you wish. The same thing in partnership. But in the category of private limited liability company and public limited liability company, there's what is called double taxation. But those people, the tax authority, they don't want to hear double taxation. Now, when we say double taxation, this is what it means. When the profit of the company is released and they say it's 10 billion, tax will be removed from that 10 billion. And after the tax has been removed from that 10 billion, they will determine how much they want to retain to continue to run the business and how much they want to give out as dividend. They call it dividend to the shareholders. So the money they are giving each of the shareholders, they will now remove tax from it again. Apart from the tax they remove from the entire profit, they call it gross profit. Then when they have removed profit from it, they now call it profit after tax. So the dividend they give each shareholder, they also remove tax from it. And that's where the concept of double taxation comes in. But you know, that one does not apply in sole proprietorship and in partnership. I hope you understand the concept of that double taxation now. Those in tax authority in our country, they don't want to hear anything double taxation. They don't agree that it's double tax. But those people are paying it. They know that what they are paying is double tax. So they have the advantages, just like the same way sole proprietorship and partnership have their advantages. Of course, they have the advantage of number, they have the advantage of having better money, they have the advantage of having money to hire experts to work for them, they have the advantage of continuity. These kind of organizations, they don't die often. They don't just fold up often the way sole proprietors will fold up. They don't just fold up often the way the partnership can easily liquidate and be dissolved. Okay? So for you to form this kind of business, you have to get the name and promote it for people to know that, okay, this business is about to start and this is what it's about to do. Okay? You have to get it registered. Those kind of businesses, you have to mandatorily, those ones are not just by choice. It's compulsory that you must register that type of business with appropriate government authority, which is Corporate Affairs Commission. Okay? And so for this type of business, you have to get the business name, you have to get the memorandum of association, memorandum of understanding, memorandum of association, memorandum of understanding, they are very, very important. Memorandum of association is what basis on which all the shareholders are agreeing, what is holding them together. Okay? That's memorandum of what? Association. So that one is internal to the organization. Article of association, okay, must also be provided. This concerns the rules relating to the management of the firm's internal affairs. It also defines the duties, rights, and powers of the board. Okay? So all the document that is required must be submitted to the appropriate authority. Must be submitted then. Thereafter, you discover that the document that relates with the outsiders will include things like memorandum of understanding, memorandum of association. You have to, in the association, you have to mention who the shareholders are, the creditors, and the place you want to locate your business, and the logo you intend to use, and so on and so forth. So you develop a prospectus where you have designed what and what about your organization will be, how you'll be appointing people to be in various positions, and your organogram and so on. Then we have another type of business which we call cooperative business. Cooperative society is a business that is usually owned by the owner. For instance, you are all students. I believe you are still hearing me. Hello? Are we still there?
Yes, sir.
Okay. Cooperative society is as simple. If you are up to 200, 300, and you come among yourself as students, and you say, okay, we want to run a cooperative whereby members should be free to bring in their money to save with us. And so if they save with us, if they want to pay school fees, if anyone of us want to pay school fees, they can easily come. If you have saved 100,000, we can give you loan up to 400,000. You agree among yourself, which means it's cooperative. That is, the owners are also the members. So that's the nature of cooperative. You see, why anytime you hear about cooperative, it's people working in the same organization that runs it, people in the similar trade, maybe mechanics bring themselves together, so that when they put money there, they can easily go there and borrow with very little interest, not like, and they will not ask you for collateral security the way banks will do, because they know you are one of them. So if you need to take a loan, you have to use guarantor among yourselves. Okay? So you may decide to use part of that money, if the money is big, to even go and buy things cheaply and bring it to your members. So things they will have bought expensive outside, you buy it in bulk for them, bring it down and share it to them. Maybe books, textbook, if it is owned by students. If it is owned by workers, they can buy food stuff and sell it cheaply to the members within the same organization. So it makes life comfortable for members. So the owners are usually what? The members. I belong to cooperative society here and there. Each time as lecturer, I've been in cooperative society in my institution. I've been able to borrow money from them. I've been able to buy goods from them. So when people have different things to use money for, come together as working together in the same place or belonging to the same common place, then they form it and they enjoy the benefits that is associated to what? Cooperative society. And so cooperative society is something that I will encourage you. Though, in any case, I've witnessed cases where there are disadvantages, where you see people they put in place to manage it for the society, they commit crime, they embezzle the money and all sorts of. But the good thing about it is there is a appropriate apparatus in each state. In each state, there is usually a state body that oversees what the cooperative is doing in every hand within the state. So sometimes if somebody wants to sit there as a chairman for a long time, the state arm will say, no, we are aware that you have been there for so number of years. Now let another person be there. And if there's any member, there's also procedures to deal with them. So you have different types of cooperative society. Okay, you have credit cooperative society, those who are basically there to give credit to those people who wants to buy things, buy it on credit. Like farmers now, you can buy your seed on credit. After you have been able to sell from your farm produce, you go and pay them what you have. You have farmers cooperative society, okay, where they can pull money together to buy tractors, which will help each of them to cultivate their farms, okay. So in essence, cooperative society is very, very interesting. So I'm not just teaching you for the teaching's sake. I want you to also look forward to be part of one when you are working or where you are now. It has benefits. It has a lot of benefits. Some may be open to members, okay? Merits and demerits of it, they are open to, if you are working in an institution, because you are a worker there, it's open to you. You are free to be member. It is democratic in management. You can challenge the authority if they are not doing things right and demand for records to be audited. So it's cooperative society are usually given tax concession and exemption by the government. You know why? Because government just see them as people who are trying to help themselves. And the cooperative society, they are not there to make big profits just the same way others are making, because they are purposely there to help the owners, the members, to make life easy for them. So it makes it possible for them to continue to be in existence for as long as possible. So in most cases, you see cooperative society existing for as long as possible. So it has disadvantages, like I've mentioned. People are fraudulent. You cannot rule that one out. I've experienced it, where a manager, a president was awarding loan to himself without making it known to other appropriate quarters. But things like that, they don't go too far before they are detected. In this case that I was mentioning, where I was working, the person was the issue was detected, the audit was done, and the person was appropriately sanctioned. And you know what? Once that one is discovered, certain amount will be deducted from that person's salary. Even if he leaves that organization, information will be passed to the new organization to make sure they consistently deduct money from that person's account. So I want to thank everyone here who has been able to be with us for the past almost 1.5 hours now. Thank you for being part of the class. So the floor is now open for questions if you have any question. So we'll be able to entertain about 1 or 2 questions before I enter into another assignment. Ipaye Joshua, I see your hands up. If you have question, please ask. Ipaye you raise your hand. Is it that you have a question? So if there is no question from anybody, I give you my promise. I will make this slide available to your class governors. Let them interact with me so that...
Hello, sir. I was unmuted.
Hello? Is it Ipaye talking? Okay. I can't hear Ipaye, but don't
Hello,
worry.
sir. Yes, sir. It's me, sir. I was unmuted before. Hello, sir.
Okay. You
yes,
can
sir.
speak now.
I want to ask, sir. My question is about this bank that was attributed to Tony Enumelu, which is the UBA bank. It was said that he is the owner of the bank. Can we call that his firm sole proprietorship? I know there are many people working under him.
No, that bank is not sole proprietorship. Let me tell you the history of the UBA you are seeing. The UBA you are seeing, they are calling UBA now. In the first tenure of Obasanjo as the civilian president, Soludo was appointed CBN governor, and I'm talking of around 1999 or 2000. That's about 26 years ago or so. There were two banks. And what led to the emergence of UBA now, I will tell you the history. Then, when Soludo was CBN governor, he came up with consolidation agenda whereby he raised the capital base of banks. So as at that time, those banks many banks find it difficult to raise the new capital base. So banks have to merge together and some have to be acquired by bigger banks. For instance, that was the time First Bank acquired a bank called Omega Bank. And that was the time that two banks came together to become the UBA you are seeing today. The UBA you are seeing today, UBA has always been in existence, just like Union Bank, like First Bank. Those are the first set of generational banks. But there was a bank in existence that time, they call it Universal Trust Bank. So Universal Trust Bank was then a new generational bank, but it has very vibrant management. And then the person that was championing that bank was so these two banks came together, and when they came together, some people are talking on the phone. So the two banks that came together agreed One, that the name UBA will be changed. And they also agree, on the other hand, that the management of UTB will be retained. That the management of UTB will be retained. So the two of them came together to become the UBA you are seeing today. So it has shareholders all across. All the shareholders of the existing UBA, they are still the shareholder in the new bank you are seeing today. Okay? But the management was considered to Elumelu because they knew he was managing the bank very well before the two of them came together. He was managing his bank very well. So the largest shareholder in any bank, they will always recognize that person as to assume that that person is the shareholder. So at the outset, those people who took over then, they were allowed to be MD for many years until Sanusi came on board as the CBN governor. He was the one who now terminated that rule. And that was when Tony Elumelu has to exit from being the MD of the bank. Jim Ovia also has to exit from being the MD of his own bank as well. Hello, Mr. Ipaye.
I can hear you, sir.
Okay, I discovered that along the line, I was muted, so I've just unmuted myself again. But you get the explanation I offered.
Yes, I did, sir. Thank you very much, sir.
So in the absence of any other question, I think we can call it a day, and I will make sure I send the slide to your governor.
Hello, sir. I have a question.
Thank you for being part of today's
I have a question, sir.
Thank you, sir.
Happy weekend to everyone.
I have a question, sir.
Thank you,
Okay,
sir.
what's your
Happy
question?
weekend to you, sir.
Happy weekend to you, sir.
Thank you so much, sir.
Hello, sir.
Someone is saying he has a question.
Sir, please, can you send us the full modules to the class rep, sir?
Yes,
Class officer, she will send it after lectures.
Someone has a
What I'm
question.
asking for is different now. What I'm asking for is different. I mean the whole modules for the whole session.
Is it the one that is always sending it?
I'm not the only lecturer taking all the modules.
Okay,
I'm only giving 4 sessions. I'm only covering 4 sessions.
Okay,
so this is the second session I'm covering.
Okay,
so I will make this one available, and when I take the next session, I will also make it available.
All right, sir.
Hello, sir.
Is that clear?
Hello, sir.
Hello.
Yes, sir. I want to quickly ask.
Hello, I can hear you. You can talk. You can talk, please.
So the sole proprietorship and registering with the CAC, you were saying some form of benefits, but I didn't get it well. Can you just shed more light on it, sir?
Yes, if you register with CAC, I will give you a copious example. There was a student of mine a few years back who during COVID-19, who had a sole proprietor business registered with government. During that COVID-19, they were asked to submit the details, their business, the income they make, how it is being spent. He sent the details to the appropriate government quarters. And they release money to the company's account, that money should be used to help the business and to keep the owner surviving. Now, if that person is not registered. If government say, okay, you want to assist this and that, what do you think will happen? The person will not be able to go and benefit from, because they will definitely ask you, where is your certificate of registration? Where is this? Where is that? The person will not be able to show it. So from time to time, there's what government normally do. Because let me tell you, government is interested in sole proprietorship, because government knows that if sole proprietors grow, they can become partnership, they can become private limited liability company. And once they are growing like that, they begin to employ more people. And when they employ more people, they are helping the government to reduce unemployment. And when unemployment is reduced, insecurity will reduce. Somebody who has job, who can make money, and and is definitely employed, will not be thinking of becoming armed robber and disturbing people or banditry and the rest. So government has interest in all these businesses, and that's what I mean. I hope it's clear now.
All right. Thank you so much, sir.
Okay.
Sir, please, what is the meaning of
Get the recording, sir.
Sir, I have a question.
Hello.
Hello, sir.
Sir, what is the meaning of CAC?
Corporate Affairs Corporation.
Hello.
Hello, sir.
Yeah.
Sir, I have a question. Sir, for instance, okay, let's make a scenario for instance where,
Hello,
for instance, I have a company which I am a shareholder. For instance, I have like 50% as a shareholder in that company, and probably something just happened out of the blue, and my existence is no more, and I have an heir. I have an heir who is to inherit from what's it called, my share, my what's it called, my share, and there's no written agreement that says my heir should inherit my what's it called, my shares from the company. Is it still possible for my heir to receive the share from the company without any agreement because it's bearing my name?
No, you see, in the issue of that your share, if you don't document when you are alive, and make that person a signatory to what is entitled to you, then there's what they call letter of administration. That's what the person will have to go and get. That's why many funds are tied up when people, the owners are dead. Many funds will be tied up and they will not have access to it. And that's why the most appropriate thing people do, anybody that you intend to inherit what you have, you make that signatory to what you are entitled to when you are alive. Okay? So when the person is carrying the evidence that is a signatory when you are still alive, then there's no problem. But once that person is not a signatory to that when you are still alive, the person will have to go through all sorts of bottleneck. Otherwise, government will just place leg on that asset. That's the end. So there are so many assets, so many funds that are tied up now that the heirs cannot access. And that's why you see they are educating people now about next of kin and all what have you. That if you put somebody even as next of kin does not mean you can inherit what you have. Okay? If you have a
So
bank
even if I have
there's
a
money
written
there,
will,
and there's money in that bank account, if you are no more, if that person that you have put as next of kin, you have not included that person in the document as co-signatory to what you have here. If the person is no more, you cannot, that money will not be accessed. You will ask the person to go to court, to go and do this, go and do that, go and engage lawyer, letter of administration. Those things, they take long process. Apart from long process, they involve spending heavily too. Certain percentage of the money there too, we also go for it. So the best thing is anything you are doing, either in business or in terms of fund or whatever, whoever you want to be the heir to you, you understand? Make that person a co-signatory. What did I say?
make the person a co-signatory.
A co-signatory. That's the easiest way to escape. Your father has this house there, he has that one there, has that one there. And so money, if you are no more, is the one that will be collecting the money and you have filled the name inside the document. No, it's only when you open that account that is receiving that money and you make that person co-signatory to that account. That's when it's valid though. So that concept is, I like that your question. It's very good.
Sir, does making the person a co-signatory means they have access to the property even when you are alive?
Yes. But then when we say co-signatory, that person cannot go alone without you approving. So the essence is ask that person to sign. You still have to cancel sign when you are alive. You understand? For that person to have that full access to it. Is that clear now? But you are the primary signatory, you can get what you want without that person's signature for what you want to get. Hello? Because you are the one who appointed that person as co-signatory to your assets. So in your absence now, you are no more, it's already recognized in law that since it's no more, he has recognized you in his lifetime as a signatory to that. So you won't go through all those redos to assess what is available. So thank you. A happy weekend.
Thank you, sir.
Thank you, sir.
Have a lovely weekend.